This week I want to talk about the rules for averaging of farm profits. The Finance Bill has introduced some radical changes, but this will not affect all farmers because companies cannot qualify for averaging. The changes which come into effect from the 6th of April 2016 amend the existing 2-year averaging rules, but then also introduce a new 5-year averaging. We have the historical records for all our farmers, but not all accountants will be in the same position. Averaging of farm profits has been around for many years and takes two forms. If the profits of one year are less than 70% of the other, it's a simple averaging process. Where the profits of one year are between 70 and 75%, there's a special calculation. The profits that are used in the calculation are after deducting capital allowances, so if you spent a lot of money on equipment, this could prompt an averaging calculation. If there's a loss in one of the years, this is treated as a nil profit. However, the loss is still available to set off against the average profits. Remember that with partnerships, it is the individual partners who claim averaging against their own profit shares. The first of the changes that this finance bill will be introducing is to the 2-year averaging rules. The marginal relief between 70 and 75% of profits has been removed, and full averaging is now available where the profits are less than 75%. These are only minor changes to the existing system, but the big change was the introduction of a 5-year averaging. And to qualify for this, you must pass the volatility test. The 75% rule continues to be an enduring feature. There are 2 tests and you only have to pass one. In the first, you compare the average profits of the last 4 years with the profits in the 5th year. And if one of these figures is less than 75% of the other, you average. In the second test, if you have nil profits in any of the 5 years, you qualify for averaging. Bear in mind that this nil profit could be the result of capital expenditure and a large claim for capital allowances. In this 5-year calculation, the profits used are the adjusted profits for tax purposes before consideration of any previous 2-year averaging or any loss claims. But you have to take into account all 5 years. You can't choose to use 3 or 4 years if that suits you better. So once your accounts and tax computations have been done for a year, then you have to consider whether you're going to claim 5-year averaging, 2-year averaging, or no claim at all. This is going to create a large amount of additional work as we scrutinise the historical records of our farming clients over the last 5 years and consider which claim may be most beneficial. There could be a lot of other complications. There may be other sources of income. There may be losses to be set off. Is it beneficial to amend the capital allowances claim? Should the profit sharing between spouses or partners in a partnership be amended? There are a lot of variables and a lot of combinations. And in each case, we're going to have to do a calculation of the tax and Class 4 national insurance so that we can advise our clients which is the most beneficial route. Will we be able to go back 3, 4, 5 years and amend capital allowances claims? As you see, this simple idea has many complications. The new 5-year averaging rules are effective from 2016-17. So if 2016-17 is year 5, then you can go back and average back to 2012-13. The amendments to the 2-year averaging also started at 6th of April 2016. So we find ourselves with 2 parallel averaging schemes. And I think they're going to be required over the next couple of years because of the volatility that's liable to arise from the current political situation. I'm Alan Long from the Long Partnership, making life less taxing.